Welcome to day 77 of me backtesting my way to success. First trade was a loss, and the reasons why I entered were equilibrium from the swing low to the swing high for our fair value gap that perfectly matched up with the consolidation that you can see right here. Then instead of the golden zone, I entered on a break of structure in the 15 minutes. Break of structure right here. Take profits were this volume area of this 4-hour consolidation that you can see right here. Created a high and a low, and it stayed inside of that box. But so that's why I thought that this was a consolidation. And also the swing high of the equilibrium. But I got stopped out. Price actually went to hunt for the volume area, not only of this consolidation, but also of the daily consolidation that you can clearly see right here. Actually, now it impulsively moved away, and that's also where I think my mistake was, because as you can see, like in the 1 hours, for example, this is no impulsive movement away from the volume area, but this is a really impulsive move, and this is also a really impulsive move, because as you can see, it reacted with the fair value gap and then instantly went up. So that's why we have this huge wick right here following another huge candle. So I probably shouldn't have entered because of the break of structure. Instead, I should have looked for a real impulsive move away from the consolidation. So let's just see how the next trade goes. And the next trade was also a loss, and the reasons why I entered were this daily fair value gap right here, equilibrium from the swing low to the swing high. You can see it more clearly in 3 or 4 hours. And I entered on a break of structure once it was inside of the golden zone. Break of structure happened right here on this candle, but I was fast forwarding in the 30 minutes, so I entered only right here. Stop loss below the fair value gap with a little breathing room, and take profit was the swing high. And this line is there because I was looking for just any confluence that went to the opposite side, that price was going to go down and not up. And this line was actually the beginning of a daily fair value gap from 2008. And as you can see, price instantly went out of it. So you could say it reacted with it. But I thought that the fair value gap is like, okay, it's from 2008. Come on, that's like 16 years ago. I just thought the more recent fair value gap would be more valid. So what I can learn from this trade is obviously that a confluence is like always valid as long as it hasn't been used yet. And it doesn't matter how old the confluence is, as long as it hasn't been used. So that's it for today's trades. Let's get on with the weekly recap. On day 70, I wrote down that I should be patient. But like I said, a friend of mine told me that if I just blow a couple of hundreds, then it's probably going to go away. On day 71, I wrote down that I'm doing very good, but now I shouldn't get overconfident, because I remember on that day I was having a huge winning streak, and even like I was planning on entering a trade, but then like my gut told me, or my market experience told me, nah, that doesn't look that good, you shouldn't enter. So I didn't, and yeah, that was a pretty good day. On day 72, I wrote down that I should keep the AMD cycle model in mind, because I was like, I think that it was the day where I entered on the distribution zone, in the distribution phase. I wrote down that I should also think about everything and look for reasons as to why I shouldn't enter before entering. So basically, what I did with the fair value gap, with the daily fair value gap from 2008, with the difference that I now know that a confluence doesn't like is never less valid as long as it hasn't been used. On day 73, I wrote down that I should give my stop loss more breathing room, and on day 74, I wrote down that I should be less greedy. Day 75, and I wrote down that I should learn when volume gets disrespected because actually it happened today again where I entered because like there was no impulsive move, but I thought that just any break of structure to the upside or to the upside in this case would mean that price has reacted with the volume area and is going to go up. But yeah, it didn't. Day 76, and I wrote down that I shouldn't enter that quickly after price reacted with one of my building blocks or one of my confluences. Because yeah, obviously, actually, you can also see that in the trade right here. It reacted with the daily fair value gap of from 2008, and then I entered to the opposite side while like the effect of the fair value gap was still going strong, you know. And today, like I said already multiple times, I should look for an impulsive move away from the volume and not just a break of structure. So this week was a pretty huge losing week. Of course, I had also like two or three very huge winning trades, but yeah, overall, actually, I think I'm still percentage-wise, I'm still I've still made profit. Of course, I can't see it because I sometimes delete the runs where I'm like complete, so where I've completed the full year. And so that's already it for today's episode. We'll see you on the next one.